So friends, now we all see that the cross-border transaction has become increased. Now it is not like that all the citizens belonging to any country, they are doing business to particular their country. Now they are going overseas, they are going abroad to do business or to earn salary, or they are shifting themselves, they are relocating in different countries for their physical upkeep. You won't believe that cross-border transactions have increased in a humongous manner. Indian residents have done $1.69 billion transaction in financial year 24-25. That is 12% increase over financial year 23-24. So now all the Indians are making global footprint, right? Not only Indians are going abroad for earning income, they are also investing in foreign financial assets. And it's a positive aspect as far as the India is concerned. But as Indians are going abroad, they are earning income from foreign, or they are investing, or they are acquiring assets in foreign. They have to be aware about the financial assets, what they are possessing in different countries, and disclosure about it. Friends, we all know that wherever we are earn income, we have to pay income tax. That is same for the entire world. But when out of India, if Indian resident is going, then they forget that whatever financial asset they are acquiring or whatever income they are earning, they have to disclose here in this country while filing return of income. जैसे पहले हम जानते हैं कि AIR एनुअल इंफॉर्मेशन रिटर्न नहीं आया था, तब सारे सैलराइड लोगों को ऐसा ही लगता था कि हम शेयर्स में ट्रांजैक्शन करते हैं पर हमारी सिर्फ सैलरी की इनकम है, हम और कोई इनकम कमाते नहीं है. But now, because of the advancement and digital technology adopted by the income tax department, we are getting all the information like interest, dividend, capital gain, or transactions through AIR. And so that we have to show that income. Now, friend, the same thing, the same technology has been adopted because of the unanimity, because of the joint efforts by more than 100 countries. And because of that, common reporting standard, CRS. Remember that common reporting standard. Under common reporting standard, more than 100 countries have signed the agreement to share information about financial assets and income about different countries' citizens to each other. And so that thing has been neutralized from 2015. And the other agreement is FATCA, Foreign Account Tax Compliance Act. That has been, that is from America. So America has brought FATCA in place from 2015, and we have signed the agreement with America. And under FATCA, Americans are bound to give details about Indian residents who are having financial assets or having income from America. So today's topic covers the important aspect about Form 67, Schedule FA, Schedule FSI, Schedule TR. Friends, as I told you, that this disclosure is very important. Showing of income and disclosure, both are very important. Otherwise, what will happen? Up till now, even as a tax professional, we were ignoring this thing. And we were not taking seriously this thing. But now, after this PowerPoint presentation, I wish that you take up this topic very seriously and you take your clients showing of or filing of return of income very seriously. Why? Because if you do not disclose financial assets, foreign financial assets or foreign income, those who are residents, then you might attract the penalty up to rupees 10 lakhs. 200% tax payable under Black Money Act. Under Black Money Act, you will be charged 30% of FMV of assets, fair market value of assets. You will be charged 30% and penalty 90%, right? And whatever I am saying, मैं आपको जो बता रहा हूँ ऐसा नहीं है कि सिर्फ वो किताब में लिखा है, उसका इम्प्लीमेंटेशन भी चालू हो गया है. In Shobha Harish Thawani's case, Mumbai Tribunal in the year 2023, they have upheld the penalty under the Black Money Act by saying that taxpayers' contentions that investment in the foreign asset was from disclosed sources and was explainable. Income from such foreign asset was offered to tax in the relevant tax year, and non-disclosure was due to an inadvertent error by the taxpayer is not tenable. So, if taxpayer is saying that whatever I have done investment in foreign, that is from the known sources, that doesn't suffice the purpose of non-disclosure of assets. So they have started to levy the penalty under different tax. Now, friends, as we talk about the taxation of foreign income, the first and foremost and most important aspect is residential status. We have to understand residential status because मेरी बात आप ध्यान से सुनिए. किसी भी व्यक्ति के लिए उसको टैक्स वो फॉरेन इनकम उसकी टैक्सेबल है कि नहीं है वो देखने के लिए हमको रेसिडेंशियल स्टेटस का क्राइटेरिया जानना बहुत जरूरी है. इवन इफ द पर्सन इज अ फॉरेन सिटीजन बट इफ ही फॉलोज द क्राइटेरिया of staying in India, the number of days staying in India that we will discuss, then he has to disclose his foreign assets and foreign income in India for the taxation. Now there are three criteria in residential status: resident and ordinary resident. So for ROR, the global income is taxable. Friends, in India, the ordinary citizen, their global income, not only Indian income, from wherever they are earning income from all over the world, it will be taxable in India and they have to offer it for taxation. So income received or deemed to be received, or income accrued or arisen or deemed to accrue or arise, income accrued or arise outside India. Then the second category is resident but not ordinary resident. In this category, income received or deemed to be received and accrued arise. So only the Indian income is taxable. Foreign income is only taxable if it is derived from business, control or profession set up in India. So please understand, friends, in case of resident and ordinary resident, the global income is taxable. Means their foreign income is also taxable. But in case of resident but not ordinary resident, their Indian income is definitely taxable, but their foreign income is not taxable. Only it is taxable. Foreign income is taxable only if it is derived from a business, control or profession set up in India. So if there is no, the foreign income has no connection with India, then it will not be taxable. And obviously in case of non-resident, the third category is non-resident, only Indian income is obviously taxable. Their foreign income cannot be taxable because they are falling in the category of non-resident. So in non-resident, income received or deemed to be received or accrued arise, deemed to accrue or arise in India, that is taxable. Now the most important section that we have to understand, how to derive the residency for particular financial year. Please pay attention, friends. The residency will be derived for each financial year. It might happen that in particular financial year, if the person is resident, then it might happen that in next financial year, his residency can be changed. He become not ordinary resident or non-resident. That might be possible. So this is the important section. Please pay attention. Section 6 of IT Act. Right now we are discussing only from the individual aspect. There is the whole chapter needs 1 hour to discuss about residential status regarding HUF, partnership firm, companies. But right now we are only discussing about individual aspect. There are conditions. What is the condition? An individual is said to be resident in India in any previous year. Is said to be resident in India in any previous year if he is in India in that year for a period or period amounting in all to 182 days or more. So if in previous year, right now we are considering financial 24-25 as our previous year. So in 24-25, if the person has stayed in India for 182 days or more, or there is either or condition. If this is the one condition, or the other condition is in previous year he stayed more than 60 days and 4 years prior to the previous year. 4 years prior to the previous year, he stayed for 365 days or more. So please understand, this is very important to consider any person's residency as resident. First condition is 182 days or more in previous year 24-25. And the other condition is in previous year 24-25, 60 days or more, or beyond previous year 365 days or more in 4 years. If either or condition is satisfied, then the person is considered to be resident. Why I am saying this is very important? This is very important because this whole presentation circles around ordinary resident but ordinary resident. They have to disclose everything that we will learn. Now, in case of Indian citizen or person of Indian origin, they have replaced the 60 days criteria to 182 days for their relaxation. Because why they have done this? Because resident has to offer the global income. So in certain cases, the government has given relaxation to Indian citizen or person of Indian origin. So their 60 days criteria has been replaced to 182 days. Then section 115C of Income Tax Act have means 182 days if their income does not exceed 15 lakh rupees, right? And 120 days in the case of person of Indian origin or Indian citizen, 182 days in case their income doesn't exceed 15 lakh rupees, and 120 days if their income exceeds 15 lakh rupees, while counting the days in case of residency. Now, friends, one important thing I want to say here, each day is counted. Each day is counted. If you arrive in India, that day is also counted for stay of India, right? So in case of person of Indian origin and Indian citizen, 182 days less than 15 lakh income, 120 days more than 15 lakh income. Now, one important thing, the income tax department has clubbed to bringing deemed residency concept. Sometimes it happens that though through passport, by passport, the person is Indian resident, but he or she is not living in India, and they are not fulfilling the criteria of residency. Means through criteria of fulfilling residency, they are not falling in resident but ordinary resident, but they are earning Indian income, and wherever they are living, there is no income tax in that country. It might be possible in certain countries of the world, there is no income tax, like Dubai. So if the person is living in Dubai, and though he or she is Indian citizen, and they are not satisfying the criteria, number of days criteria of residency, if they are earning more than 15 lakhs income, then they will be considered as deemed residents. And whatever they earn from India, they have to offer for taxation in India. Now, not ordinary resident, when an individual becomes resident in India, but what is the criteria of not ordinary resident? If he has non-resident taxpayer in at least 9 out of 10 years, immediately prior to relevant previous year, or his stay is 729 days or less in aggregate in previous 7 years. So in and all, the non-resident person, not ordinary resident person, is the person who has before becoming not ordinary resident, for longer time he has stayed as non-resident. And finally, non-resident. An individual is treated as non-resident if he does not satisfy any of the following conditions. So what are the conditions? Please again remind the condition I have discussed prior in section 6. So if the either or condition means he stays in India for less than 60 days, then he will be considered as non-resident, and he stays in India for 60 days or more, but less than 182 days, and for less than 365 days in the immediately 4 prior years. So anyhow, if any person is not satisfying the criteria of becoming ordinary resident, then he is non-resident. I hope I am clear with this. So we'll move ahead. So this is the example. Mr. A in Indian citizen works in the USA during financial year 24-25. Salary credited in US bank account. If Mr. A is resident and ordinary resident, salary earned in USA is taxable in India, right? So if Mr. A is ROR, ordinary resident, earn whatever salary earned in USA is taxable in India, and relief, whatever salary is earning and paying tax in USA, that has to be claimed through relief, that we will see later on. And if he has a property and property in Dubai, and if he has rented out, then he is earning rent income more than 15 lakh, then he has to offer the income in India. So taxability of foreign income, what kind of foreign incomes? Whatever income in India we are offering for taxation, it is same like that. So whatever income like salary or interest or rental income or capital gain or dividend or income from business or profession, whatever incomes that has been earned from foreign, that all will be taxable for resident and ordinary resident. Resident and ordinary. For ordinary resident, everything is taxable because global income is taxable. For not ordinary resident, only taxable, the foreign income is only taxable if it is in connection with India, and for non-resident, their foreign income is not taxable. Now, I hope the law is clear. Now, friend, you will ask me a question that why this dual taxation? That I am resident, I am paying tax on Indian income, and I have to pay tax on foreign income in India, though I have paid on the same income tax in foreign country. So you are absolutely right, and government is giving relief in form of foreign tax credit. That is Rule 128 of the Income Tax Rule 1962. So foreign tax credit is a relief from double taxation. An Indian resident may earn income abroad that is taxed in the foreign country and in India, right? But Rule 128, foreign tax credit, provides a mechanism to claim credit. In which sections? If a person is earning income from foreign country and that country has a agreement with India in form of DTAA, double taxation avoidance agreement, then he can claim credit under section 90A. But it might be possible, though India has a DTAA agreement with many countries, but it might be possible that in certain countries, India has no DTAA agreement. Then even though India has no agreement with the other foreign country, a person earning income from that country can take or ask for the credit uh, under section 91. So again, ordinary resident available to ordinary resident only, not available to non-resident or not ordinary resident only for Indian income. So the credit will be available only in case of foreign tax is paid. So friends, now please pay attention. I want to clear very important point. In not charging double tax, not मीन्स डबल टैक्सेशन नहीं हो, उसके लिए ये फॉरेन टैक्स क्रेडिट कैसे मिलती है? तो इट इज अ सेट ऑफ अगेन वॉट एवर अगेंस्ट वॉट एवर टैक्सेशन दैट हैज टू बी paid in India. So please understand, if foreign tax rate on particular income is less than lesser than Indian tax rate, then it will be set off and the remaining tax the person has to pay. But if foreign tax rate on particular income is more than Indian tax rate, then a person will not get refund of that foreign tax credit. So a person can get foreign tax credit or set off of credit up to the tax which has been offered in India as a foreign income and whatever tax he has to pay as per the Indian tax rate. So it is only set off rule, not a refund. And suppose foreign income is exempt, whatever tax a person has paid in foreign, but it is that income has a exempt in nature in India, then FTC will not be available. So taxpayer will be benefited up to the set off of the Indian tax. You have to submit the proof of foreign tax payment. We have to file the form 67. That is very important form that we will see later on. This is Rule 128.1. Rule 128. One, FTC allowed in the year in which the corresponding income is offered to tax. So friends, the FTC is allowed in the year in which the corresponding income is offered to tax in India. Now friends, here I want to say something that we were expecting in new income tax act, our financial year will be changed and it will become calendar year as per the global precedent. But that has not happened. And because of that, definitely we will get problem in taking set off of the credit, because on a global stage and mainly in America, the financial year is calendar year, and here we have financial year in the form of April to March. So what Rule 128 says, that FTC is allowed in the year in which the corresponding income is offered to tax in India. So whatever we are talking about earning income, that is according to the financial year of particular country. Now 128.2, no FTC is foreign tax is disputed. Okay, foreign tax, if it is disputed in the foreign country, then Indian tax authorities will not give permission to set off the foreign tax credit. Then 3, FTC available against income. Foreign tax credit is only available against income tax, surcharge, and cess. It is only available to set off against income tax, surcharge, and cess, whatever you are paying in India. It is not available against interest, fee, or penalty. So any kind of amount that has been collected in form of penal in nature, the foreign tax will not be set off against that amount. Then 4, credit is source country and head wise. Computers, okay. Then 5, conversion of foreign tax. Friends, now please again pay attention. Here the conversion must be according to State Bank of India Telegraphic Transfer Buying Rate (TTBR). SBI's TTBR Telegraphic Transfer Buying Rate. We have to consider only for the conversion, not any other rate. And that will be on the last day of the foreign country's accounting period on date of payment deduction. Okay. Then 128.8 documents required. Certificate of tax deduction. Sometimes it happens that whatever income you have earned in foreign, the foreign country withhold tax. Like whatever we are doing here, we are deducting TDS for whatever income earned. In the same manner, foreign country, if someone earns income, they withhold tax. So we have to submit the proof of withholding tax while asking for the foreign tax credit. And Form 67 that we will learn definitely, that has to be mandatory filing, otherwise FTC is not available. How you can compute step by step? First, you have to compute foreign income in INR. You must compute foreign income in INR. How you convert? Through SBI TTBR, Telegraphic Transfer Buying Rate. Now, friend, as far as conversion is concerned, for particular income, I am again repeating, as far as conversion is concerned for particular income generated in particular month, the last day of the previous month will be considered for conversion rate of SBI, right? The step 2, compute Indian tax liability.
Hello.
Just a second.
Yes, sir. Sir, if you can switch on the camera, if it's okay for you. Or is there like either you can share the slide? Ha, sir. Yes. Thank you so much.
So the step 2 is compute Indian tax liability on that income. And step 3, compare with foreign tax actually paid, right? So whatever foreign income that we have converted in Indian rupees, then we offer for the taxation, whatever tax liability comes, and whatever foreign tax we have actually paid, that will be set off, and the remaining tax we have to pay here. This is the example, like salary in UK 50,000, UK tax paid 10,000, converted 50 lakh salary, 10 lakh tax, Indian tax 12 lakh. So 10 lakh will be set off, and the remaining 2 lakh will be payable in India. Now, what are the documents required? Certificate from foreign tax authority, employers, then tax residency certificate. Now, friends, very important that we will also see, but whenever you want to take foreign tax credit of income earned in foreign, you must derive tax residency certificate issued from the foreign country. Please pay attention and understand, you must require tax residency certificate issued from foreign country if we are getting relief from double taxation avoidance agreement while filing Form 67. So if you deny filing Form 67, then you will not be allowed FTC. It is not available again interest, penalty, and late fee. And what I said, that if there is mismatch in different accounting years because of different countries, then there is some problems that is unsolved, and we are waiting for their clarification in the future. Now let's understand what is double taxation avoidance agreement. So double taxation arises when the same income is taxed in two countries, once in the source country and again in the residence country. right? So whenever in the entire world a person is earning any income, that
हेलो।
yes,
हाँ ईशान जी, कुछ अपडेट हुआ आपका कमेटी से?
excuse me, madam, your mic is open. So
अच्छा।
hello,
ओके।
Maulik,
हाँ हाँ।
excuse me.
हाँ हाँ। ओके।
हेलो
Madam, please.
एक सेकंड, एक सेकंड। हेलो। यस सर।
Okay. So for Indian residents and ordinary residents, global income is taxable. So we must require DTAA agreement,
हेलो
right? So for implementation DTAA in India with any countries, we have a section 90 and 90A. So through section 90 and 90A, we can implement DTAA agreement with other countries, and we can give the tax credit benefit to a taxpayer. So exemption method, that is long gone. Now it is a credit method. So first taxpayer has to pay tax in foreign country, and then they can take credit, as we have discussed in India. So as I said, tax residency certificate has an immense importance. Without tax residency certificate, countries which we have entered into DTAA agreement, the taxpayer will not get credit in section 94. And if the tax residency certificate, according to Indian income tax authorities, is incomplete, the person has to file form 10F if it is incomplete. In addition, mentioning all the details which has been asked in form 10F. If the tax TRC issued from foreign country is incomplete. So why double taxation relief is required? Because ordinary residents' global income is taxable, and person cannot pay tax twice for the same income. And because of that, double taxation relief is must as far as the ordinary resident of any country is concerned. And in India, it is also required. Now, section 90, where India has entered into DTAA, that we have discussed. So when the credit is available in section 90 to the resident of India according to the number of days criteria, it is not necessary that the person should have a passport of India. He should be resident according to the number of days criteria that has been specified and we have discussed. And the credit will only be available if the income is both taxable in India and foreign country. Right. Then TRC is issued form 10F, form 67. Now, section 91, unilateral relief. Now, what happens if there is no DTAA between country and someone has earned income from that country? Then also, the person will have set off of credit from that foreign country where India has no DTAA agreement. But that person has to keep payment proof of tax paid in particular foreign country for asking for credit under section 91. Now, friends, as far as the international taxation is concerned, Azadi Bachao Andolan, everybody should read this case because there are a lot of crucial aspects that has of international taxation that has been involved in this case, and we must read this Azadi Bachao Andolan. Now let's focus on Schedule FA. Foreign assets and income from outside India. हमने अभी बहुत हाइप देखा है और हमने देखा है कि बहुत सारे मैसेजेस रिसीव हो रहे हैं सबको, और लोग थोड़े टेंशन में है, हमारे क्लाइंट्स टेंशन में है कि अब क्या होगा, इनकम टैक्स डिपार्टमेंट को सब पता चल गया, ये है वो है। और आपको भी ऐसा महसूस हुआ होगा, बहुत सारे लोग आपसे अप्रोच करने आए होंगे कि हमको ऐसा मैसेज मिला है, अब क्या करने का, क्या नोटिस आ जाएगी, क्या पेनल्टी लग जाएगी, ये वो। तो आपको उसको पहले पानी देने का और उसको शांति से बिठा के ये बताने का कि भाई साहब, अभी तक आपने मेरे को सिर्फ इंडियन इनकम के बारे में बताया था, आप फॉरेन इनकम कमा रहे हो, फॉरेन में एसेट एक्वायर कर रहे हो, क्या आपको नहीं लगता है कि ये आपको दिखाना चाहिए? बिकॉज दिस डिस्क्लोजर is has not brought by the income tax department right now. This is there. This is there since years. But as I said in earlier, that people would not like to believe that whatever assets or whatever income they are generating out of country, they belong to them and they have to offer for taxation. So, friends, here I want to say very firmly that do not give shelter to your clients. Do not say that, okay, it's okay, do not worry, you are not supposed to, how can income tax department come to know? Do not keep that attitude from our side now, because clients will definitely condemn you if you do not give a proper advice to them. क्लाइंट्स हमेशा ऐसा ही आपकी गलती निकालेगा कि आपको मुझे बताना चाहिए था ना, मैंने कहा ना बोला था। आप बता सकते हो कि भाई आपने मेरे को कभी बोला नहीं है, तो हम कैसे डिस्क्लोज करते हैं? But now clients are getting messages through income tax department, and still we are ignoring, and we are not asking for information from them before filing return of income. Friends, now please understand, filing return of income is not a joke. It is not like Geo is filing return of income in rupees 24 or someone is filing return in rupees 100. अगर कोई क्लाइंट ऐसे भरवाना चाहता है तो उसको जाने दो, don't waste your time after all these people, because filing return of income has become a very crucial aspect. And now if you are not giving proper information in a full disclosure, either it is Indian income or foreign assets or foreign income, then everything is system oriented, everything is automated. Please mind well, after filing you have to give time for all the notices and all the communications. So whatever you are filing, whatever compliance you are doing, it should be done in exact manner. तो जो क्लाइंट आपकी वैल्यू करता है, आप आपकी बात को समझता है, आपको सीरियसली लेता है, उसी क्लाइंट का काम करो और उसका काम अच्छे से करो. With that, as I said, all the clients are getting messages for either their foreign income or foreign assets, not in particular. They are not giving all the information in their messages, but they are giving hint that we have all the data available with us. Whatever assets you are having in foreign countries or whatever income you are generating in foreign countries, if you are having those income or assets, please disclose appropriately in your return of income. Now it's a high time not to ignore these messages and act accordingly. And please do not give advice to clients that it is okay, it is just a message, it is not a notice. We have to change our paradigm shift as far as our practice is concerned. Sorry if I have spoken more, but this is very important. Schedule FA. Please take it very seriously. Schedule FA, foreign assets and income from outside India. So it is applicable to resident and ordinary resident, not applicable to not ordinary resident and non-residents. So it is only applicable, there is no number of days or criteria, nothing. It is applicable only to resident and ordinary resident, which has been proved according to the number of days criteria that has been discussed in section 6. And it is applicable to individuals, HUF and other entities. All entities are covered, but those who are ordinary resident. Okay. So disclosure is mandatory even if no income arises, right? If you are having assets, but they are not generating income in foreign countries, even if it is not generating income, you have to disclose. You have to disclose asset even if it is jointly held. If your name is popping up in foreign countries financial transaction, you must disclose in Schedule FA. It is, you have to disclose even if it is inherited and you have not acquired that asset. So what is the purpose of Schedule FA? Transparency of foreign holdings, global information exchange frameworks, foreign holding transparency. Then because of FATCA and CRS, now it has become mandatory. And you will invite harsh penalties under Black Money Act if you do not disclose in foreign assets, Schedule FA. So these are different notes, items that we will discuss now, which we have to discuss in Schedule FA. Foreign bank accounts, country name, address, account holder status, peak balance, closing balance. Let me. Okay. So this is the Schedule FA, details of foreign assets and income from any source outside India. Now A1, details of foreign depository accounts held, right? So what is foreign depository accounts? Depository account includes any commercial, checking, savings, time, or thrift account, or an account that is evidenced by a certificate of deposit, right? So any kind of foreign bank account or time deposits, fixed deposits, whatever you have to mention in this A1. What are the information? Country name, country code, name of financial institution where your funds are parking, address, right? Account opening date, peak balance. Now, friends, in all the columns, you will see the word peak balance. So if you are having account, or if you are having deposits, or if you are having thrift accounts, saving deposit, you have to show the peak balance, means the highest balance of the financial year for particular foreign statement, right? Now, what is A2? Details of foreign custodial accounts. Foreign custodial accounts means those accounts where we have parked our investments and they are earning brokerage from those accounts. So like we have a demat account where our shares are parked, or mutual fund units, like that. So custodial account is an account where persons, one or more financial assets are parked, right? So again, country, code, name, status, opening date, peak balance. Everywhere you have to mention the peak balance, the highest balance of funds or account balance during the financial year of particular foreign country. Now A3, details of foreign equity and debt interest held, including any beneficial interest. So though it might happen that though investment are not in your name, but you are a beneficiary and you are getting income in form of beneficiary, even then you have to show in Schedule FA, right? So foreign equity and debt interest will be, so whatever investment you have in foreign equity or debt, you have to mention in this. Then A4, details of foreign cash value insurance contract or annuity contract. So if you have taken up any insurance in your name or annuity contract in your name, that details you have to mention in this schedule. Then B, details of financial interest in any entity held, including any beneficial interest. Everywhere there is written beneficial interest. So even if you are working as beneficiary, you must disclose. So if you have, so financial interest of any entity means if you are having ESOPs, stocks, options of particular company or entity, you have to mention that details here. Everything, whatever you are mentioning in Schedule FA, that you have to convert in through SBI TTBR rate into Indian rupees. And you have to also show the income earned from this interest in this. Then C, details of immovable property held. Now, friends, in this, even if you are a joint holder of immovable property, you have to mention because your name is coming. And whatever immovable property you are possessing in foreign country, you must mention. This you have to show at cost. As far as the financial investment is concerned, like mutual fund or bank balance or annuity, insurance, in case of insurance and annuity contract, you have to show surrender value at the end of the financial year. But as far as the investments are concerned, you have to show the peak balance and TTBR at the existing at the end of financial year. So details of any other capital asset. So what are the any other capital asset? So it consists of foreign mutual funds or any foreign capital asset. So all the capital asset which has not been mentioned earlier, that has to be shown here. Then E, details of account in which you have signing authority and including any time during the calendar year, means it might be possible where you are having only signing authority. The asset doesn't belong to you. It is not in your ownership. Still, you have to mention that thing in E column, that in this particular entity, I have a signing authority. And accordingly, you have to show. But friends, mind well, NRE account balance should not be shown here. The balance in NRE account should not be shown here. Because NRE account is not a foreign asset, is not considered as foreign assets. Then column F, details of trust created under the laws of country outside India. So if any charitable entity is created out of India, and if you are a settler or trustee, then you must show that whole information in column F. Since when you have held the position, whether you are having any income through charitable entity or not, everything. Then column G, details of any other income derived from any source outside India, which is not included in item A to F. So anything which is not included above, you have to include here. This is Schedule FA. Now, friends, please pay attention. Sometimes people ask that, what about cryptocurrency? Now, I want to give clarification about cryptocurrency. Cryptocurrencies are still having defective or confusing exchange existence. So very simple, you have to understand this thing, that if cryptocurrencies are registered, are held on Indian exchange, means the government of India has approved certain cryptocurrencies exchange to regulate the cryptocurrency. So whatever cryptocurrencies that are registered in Indian exchange, that has not to be shown in Schedule FA. But if they are registered on foreign exchange, or if they are not registered in exchange, but if or in some foreign wallet, then they are considered as foreign assets and they have to be disclosed under Schedule FA in other capital assets. Right? I hope the criteria of cryptocurrency is understood. So whatever they are registered in Indian exchange, that has not to be disclosed in Schedule FA. But if it is registered in foreign exchange or in wallet, then you have to show in Schedule FA. So as I said, peak balance during the accounting year, right? Investment always have to be shown at cost. Currency conversion, the SBI TTBR rate on the last day of the month immediately preceding. So any income, whatever income you have whatever income you have earned, that has to be converted from through SBI TTBR rate, and the rate of the last day of the month immediately preceding the month in which the foreign income is due or received. Right. So as far as the please pay attention. As far as the foreign income is concerned, SBI TTBR rate you have to take is last day of the month immediately preceding of the month in which foreign income is due or received. And as far as the peak balance or other asset is concerned, you have to take SBI TTBR rate last day of the financial year of foreign country. So consequences of non-disclosure, this is a very serious thing. Black Money Act will be levied, and the 30% tax of value of asset, not just income, value of asset, 30% tax, then 3-time penalty. Then if they find it is grave, then 3 to 10 years imprisonment. So practical issues, joint accounts, it must be reported. Even if you are a second holder, you have to report it. Inherited asset that we have discussed. Okay, this is very important. If someone is saying that I have acquired asset and sold in the same financial year, still I have to report? Yes, you have to report. Even if you have purchased and sell in the same accounting year of foreign country any asset, still it is held for particular time of financial year of foreign country with you. So that's why you have to show it. Then ESOPs of foreign parent companies. Whenever I want to say about employee stock option, that whenever you have been vested right of ESOP, you have to offer as perquisites in your return of income. You must offer as perquisite in your return of income that amount, and you must disclose in Schedule FA the ESOP benefit what you have got. So what are the best practice? Collect client declaration in writing about foreign assets, verify through bank statements, tax returns, investment summaries. Always disclose even small balances. Even the small balances like PayPal, Wise, foreign current account, you have to disclose, educate clients on consequences. So friends, as I said, you must educate client for non-disclosure. Now this is not a joke. Whenever client has done, I am sure that majority of your clients have not disclosed you that whatever they are doing. But now the criteria is changed. Now the precedent is changed. We have to comply everything, and then we can do tax planning. And that thing we have to make understand to clients. Now we come up the end of Schedule FA. Now Schedule FSI, that is statement of income from foreign sources. So in Schedule FA, you have to disclose assets as well as income in foreign country. But in Schedule FSI, you have to disclose statement of income, right? It is a statement of income. So only income that will be included in computation while file return of income through schedule FSI that you have to mention. Now, friends, schedule FA, FSI, and schedule TR. ITR 1 and 4, they are not having these schedules. So do not, please pay attention, do not mistake in filing return of income number wise. ITR 1 and ITR 4 do not have these schedules. If you want to disclose foreign assets or foreign income through FA, FSI, or TR, you must file 2, 3, or 5, 6, 7. But do not file ITR 1 and ITR 4 because they do not have, and you have to revise. Suppose while filing schedule FA, if you have done some mistake and wrong information has gone, then you have a right to file revised return up to 31st December, that you all know. And you can also file updated return, but you have to show additional income. So revised return you can file up to 31st December. Again, back to schedule FSI, statement of income from foreign sources. Filed by resident and ordinary. Everywhere there is a resident and ordinary resident because their global income is taxable. On foreign income, relief under DTAA. Purpose of schedule FSI to provide country-wise and income-wise breakup of income on outside India, tax paid outside India, relief claim. So whatever information you are putting in schedule FSI, that will be reflected in schedule TR, that is tax relief schedule. Some of the information will highlight automatically in schedule TR that we will see. So what are the things you have to, country code and name, taxpayer identification number, TIN number that has been issued to particular person in foreign country that you have to mention. Then head of income, what is the head of income, salary, house property, business, capital gain, other sources. Then income from outside India, gross amount of foreign income earned before tax. So whatever income you are offering, you have to offer gross amount, right? Again, this is the same that we have discussed, but please understand gross amount of income, not net of tax. Gross amount of income you have to offer for taxation. And tax paid outside India, whatever actual tax you have paid, you have to mention. Tax relief claim, right? Whatever relief you are getting after calculation, that you have to mention. So flow of information, as I said, from schedule FSI, it will go to schedule TR, some of the information. So if foreign income is not reported in schedule FSI, FTC cannot be claimed. We will see form 67. But even if you are not mentioning foreign income in schedule FSI, you cannot claim FTC. And if you do not report, you will attract penalty under section 270A. That is, non-reporting and misreporting penalties may be invited by not doing this thing. So there is a series of penalties waiting for you if you are not complying now, as far as disclosure of foreign income and foreign assets is concerned. So this is the schedule FSI. Now, first we will learn schedule TR. Okay, this yes, schedule TR. So this is regarding claiming of tax credit. So schedule FSI, after filling up schedule FSI, it will capture some of the items in schedule TR, that is tax relief under section 90, 90A, 91 through rule 128. Now, the most important thing, form 67. Now, friends, after deciding the residential status and for avoidance of double taxation, the most important form is form 67. If you have not filed form 67, then you cannot be allowed to take credit of tax paid in foreign. And you have to file before filing return of income. this Form 67. So what are the documents required? Just a second. What are the documents required for filing Form 67? Mandatory documents, proof of foreign income, means whatever income you generated in foreign, the proof, salary slip, contract agreement, dividend, capital gains, proof of foreign tax paid. As I said, tax withholding certificate you need to acquire. Then tax deduction or credit statement, copy of filed foreign tax return if it is available, tax payment challan or receipts, then tax residency certificate, very important, issued from foreign country, and foreign tax credit certificate. Because while filing Form 67, whatever documents which proves that you have paid tax in foreign, now you want to get relief under FTC, you must attach with Form 67. You must attach with Form 67 to justify your claim regarding claiming foreign tax credit. So if TRC is incomplete, Form 10F you have to file. Exchange rate that we have understood. Attachments you have to attach that I have said. So before filing ITR, you have to submit Form 67. Okay. Now, if you are generating income, foreign income year by year, and you're having foreign assets, then you must maintain all documents for 7 years at least. Because if there is notice will be there or scrutiny notice, they can ask at least 7 years data for claiming of your credit. Now, friends, please pay attention. Form 67 is a single annual form. Sometimes you may ask me a question that what about the tax paid for income earned in different countries? So we have to file different Form 67 for each country. So answer is no. Form 67 is a single annual form, and there is a provision to show different countries' income and details in one single annual form. But even if there is a 5 country, 10 country, you have one income, you have to show in one single form, Form 67, and there is a provision of it. So I want to show you some glimpse of Form 67 through video presentation. Please pay attention. This is very important form. So please pay attention on this video presentation. You have to log in, then e-file, then income tax forms, then file income tax forms. Then you have to go persons non-dependent on any source of the third line. And in that, you will see Form 67, double taxation relief form in 21 to 30 criteria, Form 67, file now. Now you can see the first page, you have to select assessment year, then continue. And let's get started. There are part A, part B. First, verification and attachments. All the proofs you have, you must attach in Form 67. Please mind well. Then part A, first we have to fill part A, name of SSE, PAN, address. Now, here, you have to first mention name of the country. Then source of income, income from outside India, tax paid outside India, all the details, credit of tax paid. either it is section 1990A or section 91. You have to show. Then there is an option, please below add. So in that, you can, if you are having any other income from other country, then you mention in part A. So that in that way, it will be reflected. Now part B, whether any refund of foreign tax has been claimed in any prior accounting year. So if you claim any refund of foreign tax paid, then you will not be allowed credit, right? And whether credit for any foreign tax has been claimed, which is under dispute. If there is any dispute for foreign tax paid, then it will not allow. And you have to mention it correctly. The last part is verification and then attachments. Again, you must attach everything which establishes your claim regarding foreign tax credit in Form 67. And now you can generate and then proceed to verify. So this is a short video description regarding Form 67. As I said, even if you are earning foreign income from different countries, you can add n number of details of different countries foreign income you have earned. Coming back to our presentation. So friends, Form 67 is very important. Please file it before filing return of income. Okay. So this is the TR schedule that we have done. Now tax residency certificate. A tax residency certificate is an official document issued by Income Tax Department of India to individual or entities proving their status as tax resident of India for a specific financial year. Now friends, if you want to take foreign tax credit, then you need a tax residency certificate issued by foreign country. But it might be possible that sometimes your tax is withheld in foreign country and you want to take credit of that, then you must require to establish your residency and you must require tax residency certificate issued from Indian government. So that has been issued by the Indian government. So claiming DTAA benefits, withholding tax reduction, establishing Indian tax residency. So if you want to establish your Indian tax residency, you require TRC issued from Indian government. So you have to file Form 10FA. It is applicable for any resident taxpayer, individual HUF, company, firm, or any other entity. You have to file Form 10FA, and the TRC will be issued in Form 10FB. Okay. And as I said, you have to file Form 10F if the TRC from foreign country is incomplete for getting credit under 1995, right? So for Indian residents seeking TRC to claim DTAA abroad, Rule 21AB, Form 10FA, you have to file for getting TRC, tax residency certificate, and you will get TRC in Form 10FB. So this is the step-by-step procedure how to file Form 10FA for getting TRC certificate. You have to fill details, different details that has been mentioned. I will share my PPT. You can see later on. You have to attach documents, then jurisdictional AO, and you will be issued TRC in Form 10FB. For foreign residents seeking TRC, if there is a USA, you have to apply IRS for Form 6166, and this is the academic thing. So points to remember. So TRC is a period specific. Everything is related to particular year, right? So for every financial year, you have to take different TRC. Now, friends, the most important Black Money Act, where we must fear through this act, because the Black Money Act has stringent penalties and prosecution powers if we are not being honest as far as the foreign assets and foreign income is concerned. So the BMA is self-contained code, undisclosed foreign income and assets you have to disclose, right? Resident in India, 30% that we have discussed. Scope. What is the scope? Section 4 suggests Black Money Act 2015. What is the scope? Foreign income not disclosed. Foreign income for which return should be filed, it is not filed. Asset is not disclosed. And one most important thing, whatever tax you are paying under Black Money Act, that will not form part of total income under the income tax act. So you have to pay here double tax for following both the laws. So no deductions at all permitted. So someone has asked that whether we can use RBI reference rate or not in questions. So RBI reference rate is used for currency conversion in Black Money Act. As far as Income Tax Act is concerned, it is SBI TTBR rate. So for deriving the value of assets, not the value, fair market value of the assets, you have to take the RBI reference rate on the valuation date, not SBI TTBR rate, right? So now it is clear. Assessment. There is a whole procedure of assessment and appeal and recovery. So penalty, as I mentioned, three times of tax and 90% of FMV, fair market value, is a penalty under Black Money Act. So if you fail to furnish return by disclosing everything, asset, income, if you fail, then there is 10 lakh rupees penalty per default. It is per default, right? Mind well. One small relief is given from 1st October 2024, and that is that rupees 10 lakh penalty will not be applicable in section 42 and 43 if non-immovable foreign assets will not, the aggregate value of non-immovable foreign assets will not exceed 20 lakh rupees. It is non-immovable foreign assets. So some relief is given as far as the non-immovable foreign assets. 10 lakh penalty will not be levied if the aggregate value of the assets will not exceed 20 lakh rupees. Otherwise, section 42, 10 lakh penalty, and in section 43, it is for small bank balance, right? And there is a prosecution power. There is a whole bunch of prosecution. Then section 49, willful failure to furnish return, rigorous imprisonment for 6 months to 7 years. Section 50, willful failure to furnish information, 7 years. Section 51, willful attempt to evade tax penalty or interest. 52, false statement in verification. Penalty is there. 54, presumption of culpable mental state. 55, if it is sanctioned by all the higher authorities. So whole bunch of penalties and prosecution. Now, friends, last two issues I want to discuss before summing up. Sometimes it happens that through Hawala, unaccounted money or cash is shifted to countries like Dubai or some other countries where they accept cash for purchase of assets. So what happens that some of the people are shifting their, now started to shift their unaccounted money through Hawala to countries like Dubai, and they purchase assets in cash. So what will be the repercussion? Let's understand. Modus operandi, unaccounted cash generated in India through unlawful means. They send it through Hawala. Cash used in Dubai for purchasing assets. Assets held abroad is not disclosed in Indian ITR or Schedule FA. Obviously, it is purchased in cash, so it is not disclosed in Schedule FA and ITR. And people think that they have escaped the taxation and now they can enjoy the pleasure of life. But wait, Why they are sending to Dubai? Because there is no income tax, right? Cash transactions are allowed. But now wait, because of CRS with more than 100 countries, including UAE, now there is automatic exchange of information has been started. So I don't want to say anything, but I really want to say to everything that anything you have done this kind of stupidity, please disclose now through Schedule FA or Schedule FSI, because it will definitely hound you, and the information department is getting information through CRS, even from Dubai or UAE. So now what is the repercussion? Income Tax Act, if you have done this kind of stupid transaction, then undisclosed income in income tax at the rate 60% plus surcharge plus penalty, which accumulates 78% under Section 115 BBE. Just wait. Then prosecution under Income Tax Act 276C, willful tax evasion, right? Now Black Money Act comes, applies specifically to undisclosed assets abroad, right? Then tax at the rate 30% of the same value. Again, tax on tax. Then penalty 90%, prosecution 3 to 10 years in Black Money Act. Then the third player, FEMA, that comes. Residents cannot invest abroad without RBI permission. You have not taken the RBI permission. FEMA comes into picture. What is the consequences of violation? Confiscation of property. Now property has gone. Tax has been paid. Everything is gone. Penalty up to 3 times of the amount involved. Now the fourth player, Prevention of Money Laundering Act. If source is unlawful, this is money laundering. Properties can be attached by enforcement direct. ED will come into picture. Prosecution under PMLA, rigorous imprisonment. So friends, do you think it's a rational transaction? Do you think if someone is doing this, it is for peace of mind? Answer is no. It is a very stupidity. If someone is doing, please restrict them. Please tell them to disclose everything and get rid of the penalties and prosecution at least. Forget about the tax. Now, friends, the last aspect, FEMA and capital account transaction. What is FEMA? Foreign Exchange Management Act. Current account, capital account. Capital account transaction, we understand. A transaction which alters the assets or liabilities, including contingent liabilities outside India of residents or inside of non-residents. Now, friends, Foreign Exchange Management Act is governed by the RBI, and it is very important. Somewhere there is no application of income tax or Black Money Act, but you cannot escape as far as the repatriation of money is concerned, or purchase of foreign assets up to what amount is concerned. There, it is also restriction. You cannot purchase an amount, purchase asset of a high value transaction in 1 year. Through FEMA, you have a restriction to invest anything in foreign country up to certain amount. So purchase of property outside India by resident, foreign investment into India, borrowing in foreign currency, lending in foreign currency, investment in foreign securities, setting up branch office abroad, acquisition of immovable property, guarantees given. Anything that creates a capital asset or liability abroad in India involving forex, that is called capital account transaction. Again, I am repeating, anything that creates a capital asset or liability abroad or in India involving forex. So not only foreign country, even if you are purchasing in India that involves forex, then it will be termed as capital account transaction, and FEMA will come into picture. So regulation of capital account transaction prohibited unless expressly permitted by RBI. So RBI is governing authority, and you have to take permission if it is beyond the FEMA. Control through RBI notification, master direction, and LRS, liberalized remittance scheme. Okay, investment up to USD 250,000 per year under LRS. So per year, up to 250,000 USD, you can invest through forex, involving forex in foreign country or India. not more than that. That is restricted in FEMA. Foreign property, what is the permissible? This is not more than 2,50,000. Then foreign property acquisition through inheritance, gift, or investment approved by Indian corporates under overseas direct investment ODI regulation that is permitted under FEMA. Okay. Why serious from compliance point of view? Again, the penalty aspect 3 times, continuing contravention 5,000 per day. Friends, in all these acts, income tax, black money act, FEMA, all the penalties are huge and the consequences are grave, like imprisonment. So now they will not tolerate if you fool the authorities or countries, and by not paying tax, you enjoy the pleasure of life. So everywhere there is a higher authority here, and ED is there, right? So this is the practical scenario. So what are the practical challenges in foreign income and asset compliance? Now you will say that you have enough feared us, but now give the practical challenges. Listen the practical challenges. So this is the practical residential status determination. First and foremost, residential status determination, that you have to take all the information from the client and you must decide residential status appropriately. Otherwise, the wrong disclosure is not even invited or good, right? Correctly establishing ROR, NOR. Then collection of information from foreign sources. That should be accurate. You have to really praise clients to collect all the information from foreign bank statements, dividend slips, broker reports. So sometimes clients will say that it is not possible, then you have to make them possible. Otherwise, you have to say that I will not file it, return half-heartedly, because there is no option left for any excuse. Then foreign tax credit documentation, again form 67 before ITR. Currency conversion complication, I make you understood. SBI TTBR for Income Tax Act and RBI reference rate for Black Money Act valuation. Schedule FA complexity that we have discussed. Schedule FA, you have to study and fill up the details. Overlap of multiple laws, this is the problem, but it is there. Harsh penalties and prosecution, mismatch between Indian and foreign compliance cycles. So this is the most important problem, that mismatch between Indian and foreign compliance cycles. That we will see that something is coming good if it will in the future. Beneficial ownership and trust disclosure, changing regulatory landscape, global information sharing. So everything is being shared. So you cannot escape valuation challenges. So now best practice for tax professionals in foreign income and asset cases. After discussing everything, let me tell you one thing, that this is the most important chance to upscale your taxation practice, not remaining limited to domestic taxation, but now you can definitely go for international taxation. You can definitely take care of your good clients who value you, who pay you according to your hard work that has been put by you. So start with residential status, systematic data collection, prepare log of all the data you have collected, and take sign of your client, and also prepare questionnaire that whether this document is submitted or not. Educate clients on disclosure. Whatever you are expecting, first you have to educate your clients to render them. So you must discuss at length every aspect of disclosure with clients. Documentation discipline, then compliance calendar, stay updated on multiple laws, risk management and professional safeguards. Build expertise in network. This is a very new and rare area to do practice. So become expert so that people will approach you fearless and you can give a real solution to them. Use technology as much as you can, adopt a compliance first mindset. Now conclusion. So in today's globalized economy, cross-border income and assets are no longer exceptions but realities. For Indian residents, this brings stringent disclosure obligation, complex compliance across multiple severe consequences, right? But as a tax professionals, our role is to ensure compliance first, planning next. Compliance first, planning next, so that clients remain safe, confident, and future ready in their global financial dealings. And I want to end this discussion with last quote. Ignorance of law is not an excuse, but awareness of law is your greatest protection. So now the time has gone that you are ignored from the law. If you are, because of the use of technology, if you have become aware about the law, please now do not ignore it. After becoming aware of the law, now if you are ignoring it, then God will help you. Thank you so much for the valuable time. I'm ending my discussion.
Thank you, sir, for this wonderful presentation. And now I request Sridhar Shahji, the immediate past president of ITBA, Income Tax Bar Association, Ahmedabad, to please take up the question answer session. The forum is open for the participant to raise their questions. Following that, I would request Parth Doshi ji to please take up the vote of thanks once the Q&A is done. I recognize the presence of Honorable Secretary of Mr. Parth Doshi ji. Welcome, sir. Sridhar ji, you are on mute.
Yes, thank you. So we had a really wonderful session by Karthikeya, and he has covered so many things, new things. And at the right time, when we are in the mid of the ITR filing season, there are a few questions. Few are already answered in the session, but we are taking first. I'm taking from the Q&A box. Karthik bhai, if you can also open, it would be easy for us. There is a question that if a person stays more than 180 days in India and they hold some other country passport apart from India, they fall under which residential status? Are they ROR or RNOR?
So as I said, it is not 180 days, it is 182 days. So as I said, we have to strictly see the number of days criteria as far as proving the residency, as far as the filing of return is concerned. It doesn't matter whether the person is having passport of India or some other country. Two things we have to see, the number of days criteria and Indian income. Sorry, foreign income.
The next question is, I think it is very clear. If a person is non-resident, in that case, for foreign income to be disclosed in exempt income. So I think the session's title itself says it is for residents. In case of parent foreign company, shares are given to employees working in India. Few shares are sold off to make payment of taxes in foreign country. Will we get DTAA on this transaction? A foreign employer has given the shares of foreign company
Yes,
to
basically, it's a capital gain on which you have paid tax in foreign country. So you have to offer that income while filing return of income. And along with that, you have to file Form 67 for claiming credit, whatever tax you have paid in the foreign country.
And yes, I would like to add that if DTA is applicable with that country, you can refer to DTAA, whether it is an applicable transaction under DTA or not. That has to be checked for each and every transaction. How can we know TRC is correct?
That you are not supposed to see. That income tax authority, income tax authorities or income tax department has given us a lot of work to do. So some work is left to them. Please let them work also.
Yeah.
So they will verify and they will say that it is correct or not. But everything is identify unique number. So I am sure that all the foreign countries, whatever they are issuing any certificate or any legal document, they are having number. So through number, They can verify it and they come to conclusion.
Shares are to be shown for calendar year or financial year. I think the context is missing here. So leave this question in
We
my
are talking
opinion.
about foreign income, and in foreign majority there is a calendar year.
Okay.
So everything you have to show according to the calendar year.
Cryptocurrency valuation, how to be done?
That is, I am not aware of even because I don't deal in cryptocurrencies.
In Schedule FA, the income also to be disclosed. I think FA is for assets, right?
No, in Schedule FA, you have to mention assets and any income you have received for particular financial year out of that asset. You have to mention side by side. So income you have to disclose, yes.
So when to file Form 10F and when to file Form 67.
So it is do not confuse yourself. Form 67 you have to file before filing return of income for claiming tax credit of foreign tax you have paid in foreign country for foreign income. And in Form 67, you have to attach TRC issued by foreign country. But if there is incomplete information according to authorities, then in addition, you have to file Form 10F to mention other details. So at that time, you have to file Form 10F. Otherwise, in Form 67, you have to attach TRC.
So there are multiple questions. I sum up as one question with multiple points that is related to ESOP given by foreign companies. At times, parent foreign companies are giving ESOPs. So number one, whether to disclose it under unlisted shares option in ITR. Second is what will be the peak value as, and third is what would be the disclosure, because the most of the time for foreign it is on December end. So what to be disclosed in this year's return. And the last question is where to show dividend received from foreign companies.
So as far as ESOP is concerned, and my knowledge is concerned, whenever you are getting ESOP from foreign companies or multinational company, at the time of receipt of ESOP, you have to straight away mention through conversion the amount in perquisite, and you have to offer for income. And as far as the dividend receipt is concerned, you have to show the investment in particular company's shares in number and in amount in Schedule FA. And with that, you have to show dividend income.
Okay. There's a question, FA and FSI schedule applicable in case of resident person doing export sales.
All the income, either it belongs to business, profession, other sources, house property, all the income you have earned from foreign country, you have to offer it as income, foreign income in your return of income, and you have to show, means as far as only income is concerned, you are not supposed to show in Schedule FA. But if there is asset and it is generating income, in context of that asset, that income you have to show in Schedule FA. So if you are generating any income from foreign country out of business, you have to state, you have already offered in foreign country for taxation, and now you have to offer here because the global income for Indian resident is taxable.
So I think in chat box there are multiple messages related to the SBI rate and RBI rate. So I think you have made it clear that as per Rule 115, it is the SBI rate, and SBI rate is available on the website of SBI. So it is very clear. You have already cleared in while discussing black money also.
SBI TTBR rate, as far as the FTC is concerned, foreign tax credit is concerned, we have to consider only SBI TTBR rate accordingly, income and asset, there is a different criteria that I have discussed.
Yes. So I think also, can you please elaborate a little bit about the foreign currency rate on the last day of accounting period as on deduction? That is what's written in the chat, but yes, you might get the question. I think question is not very clear.
To know the particular foreign currency rate, I will share by updating my PPT. Right now, it is not included in PPT. I will share so that you will get the link to see the particular conversion rate. Right? I will give in the PPT.
So everyone who has asked questions related to PPT and where we will get the PPT, so you can subscribe to the channel of GyaanStation, and on GyaanStation channel, the PPT would be available. Also, the respective association will share the PPT through their official WhatsApp channels or email channels. Also, the webinar recording is available on the GyaanStation's YouTube channel, so this can be accessed anytime from there. There's a question is what is taxability of social security benefit received by a resident from USA? The person is US green card holder and now shifted to India forever. As per Income Tax Act, he is the resident of India.
Where is that question?
It is in the chat at 541.
Can you repeat the question?
Yeah, so there is a person who is a US green card holder getting benefits from Social Security in USA, but he has shifted to India permanently and resident of India for Income Tax Act. So what would be the taxability of that amount received under Social Security benefit?
So as I discussed, you are not getting any benefit if any income is exempted in foreign country. So whatever is taxable in foreign country, and if you are paying tax, the whole gimmick is around taking credit and disclosure of, because even in our return of income in computation, there is no any tax applicable for exempt income. So if, as I am aware, social security benefit is exempt as far as the taxation of American taxation is concerned. So whatever income you are generating and you are not paying tax in foreign country, on that you will not obviously get foreign tax credit. And if it is exempt, then obviously it is not taxable as per my knowledge in India. And as far as the export sale question is concerned, the person has asked that what to show in such as the net income. I want to make it clear that as far as the taxation is concerned, everything is considered as gross. But in case of business, your net income will be considered as what we are seeing showing in our profit and loss account. So all the income that will be shown except business or profession, that is on a gross basis.
Yeah. So we'll take last two questions. Meanwhile, the participants can share their reviews too and in the chat box. So Dipti, if you can check the chat box is open for everyone. I hope it is. And the second last question, the resident SSC received bank interest from NRE account with SBI, India. Whether it is exempt?
Obviously, it is exempt.
It is NRE.
Interest from NRE account is exempt.
But to a resident assessee.
Hmm?
To a resident assessee who is resident in India.
Interest from NRE account is Indian income. It is not foreign income.
Yeah. So last question, in case there is a foreign income but no withholding tax, do we need to show in FSI schedule?
Yes. Absolutely, yes.
In case
even if there is no withholding tax, but that income is taxable. If it is exempt, then write into exempt income. But if in foreign, if you are offering that income as a part of computation, you have to offer here also in schedule FSI. See, logic is very clear. Whatever you are doing here, as far as the taxation is concerned, you have done as far as the taxation of other countries is concerned. But here in India, whatever you have offered as income in foreign country, simply you have to offer in India for income. It might be possible, and I am not aware because we have to see the DTAA agreement for particular country, that it might be possible that in foreign countries something is exempt, but in India it is taxable. So again, you have to offer that exempt income where no tax is charged in foreign country for the tax purpose in India. But for that, we have to see particular DTAA agreement with all the countries, means particular foreign country. So all the income, whatever whatever you have earned out of assets in foreign country or anything, what you earn, you must disclose in India if you are fulfilling the residency criteria of being resident but ordinary resident. So this is the crux.
So before I give it to Parth for vote of thanks, I would like Kartikeya to give us 3 or 4 important points that everyone should remember in a queue so that they can help their clients out. What could be the crux of this total session in 4 sentences?
Yes, Sridhar, I will definitely say 4 sentences. So first sentence is, please expand your vision. You are a tax professional and you are not ordinary data entry operator. So not only vision, knowledge. Please expand your vision and knowledge. Second thing, please understand the background of your client and please make them literate as much as possible. If they do not know what is this world has become as far as the taxation and what is the updation is done, ગુજરાતીમાં કહેવાય છે કુવામાં હોય તો હવાડામાં આવે. So basically, whatever updation and advancement, whatever done in taxation world, if the client is not knowing, then they will commit this mistake again and again. Third thing, whatever today I have discussed, if you try to do it genuinely and with positivity and honesty, it is very simple. Just that you have to compel client to bring the detailed information and then you have to start your work. Unless and until you are not getting enough details, do not indulge in any filing. Because once you file, the responsibility comes to you. So whatever details you want, you ask clients to bring, and till that time, do not file anything. And the fourth thing, now the time has gone that you are not updating yourself as a tax professional. Now, because of the technology, because of the artificial intelligence, you can get everything on your fingertip. So make the best use of it. Try to learn every day. Don't think that I am not having any client who has a foreign income or foreign assets. Why should I worry? You don't know the worth of your clients. And it might be possible that if the client will come to know about you and they will approach you, then you should not look like a fool that you don't know. Sorry, I am using the harsh words, but that you do not know anything about foreign asset disclosure or foreign income. So be prepared. Now this is the future of taxation. And I mean it. So please learn everything what you can learn about international taxation, foreign asset disclosure, getting foreign tax credit. And it might be possible that someone will come to you to take the genuine help from you. And at that time, you must render the honest and genuine, and you must charge them enough. Don't negotiate or do not bargain for what you are rendering. Thank you so much.
Yes, Parth, over to you. Yes, we need to unmute Parth also.
Thank you, Sridhar. I, Parth Doshi, Secretary AGFTC, on behalf of All Gujarat Tax Federation of Tax Consultant and our brother association, Income Tax Bar Association, Ahmedabad, and Gujarat State Tax Bar Association. Thanks to today's speaker and our own Advocate Dr. Kartike Shah for giving and sharing his depth knowledge for today's subject, that is taxation of foreign income and disclosure of foreign assets by Indian resident, which is nowadays a big challenges for a person who is dealing in the global business in this era. His his depth knowledge will help to get clarification to attendee of this webinar about the disclosure part, because this disclosure is mandatory from assessment year 2025-2026. I also thankful to CA Diptijan for providing a platform and coordination through GyaanStation platform. At last, I also thankful to all the attendees of this webinar for sparing their valuable time for getting a depth knowledge about the disclosure part of foreign transaction. Thank you very much.
Thank you so much, Parth, and everyone who is involved in today's webinar and all our brother organizations, Ashutosh ji, Kartikeya ji, Sridhar bhai, Prateek, Parth, Maulik in his absentia, everyone who is associated with this webinar. It's a combined effort of each individual who is attached with this organization to bring this knowledge sessions every week in front of all our professional brothers and sisters, and we will keep continuing the good work with the motivation of seniors like Ashutosh ji and all other seniors. Narendra Karkare ji is also there with us. So it keeps us motivating
Left of the
to do good work with each coming webinar. Soon we will announce our new upcoming webinars. We'll continue the next week again. We will meet for with a new speaker and a new topic. Thank you. Till then, stay tuned and keep good care of your health and study. Knowledge is power. As the Sir Kartikeya sir said, daily study something, learn something new before you sleep. Thank you so much. Here we end our today's session.